Now, the catalyst for today's event was our recent exciting announcement of our strategic partnership with East Bay Investment Solutions. So this afternoon I have with me Eric Stein. Eric is a chartered financial analyst and partner at East Bay. Eric, welcome. How are you?
I'm great, Dennis. Thanks for having me. It's good to be part of the call today.
We're going to talk about current conditions, some of the other areas that we've been focusing on for our clients. But first, by way of introduction, maybe share a little bit about your background and the work that East Bay does.
Sure. In terms of my background, it's been pretty broad and varied. I've had the opportunity to work in a couple of different avenues and experiences. My career has essentially been, the bulk of it, it's been in two major places. One was in the late 90s. I had the opportunity to join Goldman Sachs Asset Management in New York City. Fast forward to 2005, my family and I decided we wanted to move south and leave New York City. And we moved to Charlotte, North Carolina, where we are now. And I had the opportunity to join as the senior most investment professional, a multi-billion-dollar national registered investment advisor. So, if you look back at my career, I actually started my career at a commercial bank in 1994. So I had the experience of seeing what happened with treasury rates very early on in my career. If you remember back in 1994, we saw treasury rates sort of explode in a very short period of time. Fast forward to the late 90s, and I had the opportunity to work at GSAM through the internet bubble. It was a fascinating experience to be able to see sort of product creation, marketing, how the machine works, and how to really risk manage portfolios during a very difficult time as well. Again, fast forward to 2008, and we were responsible for a few $1 billion under assets under management during the great financial crisis. So it's been a really interesting experience to see positive times, difficult times. It's been, I'll say a blessing to have all those experiences throughout my career, because it just brings a lot to the table from, what to see, how to react, how to think about it, and how we communicate with clients. So from an East Bay perspective, I joined East Bay in 2018. It's my partner, Mario, and myself. And we essentially work with advisors like Morton Brown, providing investment support, expertise, how to think about model portfolio construction, how to think about what's happening in the markets. So we're really what we call an OCIO. It stands for Outsourced Chief Investment Officer. But we're really meant as a support team to what the great work you're doing at Morton Brown Family Wealth.
So, Eric, I thought I'd start with a couple of slides to show what's been happening recently across stocks and bonds, because here we are about 1 year from the absolute bottom of the collapse of the markets last year. So if you want to check out a chart of your performance, if you've been in the stock market, today's a good day to do it. But that recovery's happened in fits and starts. There's been different phases of it. The last 6 months have been really interesting. So I'm going to pull up a chart. The top chart is just the S&P 500 growth and value indexes. And then we have 10-year treasury rates and 30-year treasury rates. We're in a different place than we were in October of last year, or especially in June or July of last year. Tell us about where we stand here at the end of the first quarter, 2021.
But if we're looking at where we are today, it's been a really interesting several months. Almost since November, we've seen some changes. Some of that can be related to the election and changes in leadership of the country. Some of it could be related to the COVID vaccine. And we've started to see, since the vaccine became more available, we've started to see, better views of what economic growth is going to be. And as we all know, the markets are forward-looking. So, they've sort of pictured the benefits that we've seen from the vaccine over the last couple of months. They were looking at that benefit several months ago and pricing that into the markets. So if we look at that top chart and we see growth versus value, growth was the rage all of last year and for several years before that. And now we've seen a bit of a change. We've seen leadership change in terms of a lot of the more value-oriented securities being more successful in terms of return than the growth. Why is that? Again, there could be a number of reasons. I don't like to point to just one, because it's never just one. But if you look at what's happened, some of it could be because growth had done so well. The trajectory was so steep for so long, it just couldn't maintain that level of leadership. Some of it has to do with the market environment. Again, a lot of the value-oriented stocks, especially last year, are the ones that were most impacted by the virus itself. And now that we see the economy recovering, those securities stand to benefit. So again, there's a number of reasons why these things can happen. From a fixed income standpoint, we've seen treasuries sort of jump in the 10 to 30 year range. Again, if we look down at the chart, we were a little over 60 basis points last October. We're now at a little over 160. So, we've gone up fairly significantly. Even from year end, we were at around 90 basis points. We've increased 70 basis points in just the last 2.5 months alone. The interesting thing is, if you looked at short-term rates, cash rates, those are still pegged at zero. And the reason for that is the Fed. The Fed has stepped in and said, we are going to leave short-term rates at or near zero for the foreseeable future. They want to see gains in employment. And in particular, they want to see an average of 2% inflation before they start making any changes. So the longer term part of the graph, again, that 10 to 30-year market, is driven by investors, where the short term is driven by the Fed.
And this really tells us what we can earn on safe money. And I think all of us feel that. One of the most frequent questions we get from clients is, I have this cash sitting here. Maybe I've been sitting on it, just making sure as a safety cushion, but it's earning next to nothing. And that's this next to nothing part is what Eric just said. That's what the Fed is controlling, is what those short-term rates are. But in some cases, it's a win for people with cash to have rates go up as they have. But on the other side, you can get burned trying to reach for yield too. So tell us a little bit about what happens if you're reaching for yield in long-term bonds. If you're trying to get this 4% out here in 30 years or 1.6%, what happens to bonds if you reach for yield and rates start going up too fast?
Yeah, well, let's start with the cash question, because I think that's been one of the most popular questions we've heard from clients across the board over the last couple of years is, what do I do with cash? It's just not earning anything. But when we see rising interest rates, it's sort of a double-edged sword. Savers have been absolutely killed over the last many years just because there's nowhere to put their cash. You're not earning anything on cash. But in a rising interest rate environment, the road from lower rates to higher rates can be a difficult one, in particular for some fixed income. As rates go up, your prices go down. That means your return can often go down. So it can be a little bit of a bumpy ride from low rates to higher rates. But over time, it's actually a benefit for investors for the exact reason you said, Dennis, is, the higher rates that you have, the more you can return on your cash, the more return you can earn on your fixed income. Best way to think about the future return you can earn on fixed income is current rates. So if you look at that 10-year treasury at 163, on an annualized basis, if you bought a 10-year treasury today, you can expect to earn 1.63% per year for the next 10 years in a treasury. If you go back 10 years, that was much higher. So there's just not as much return today in fixed income as there was, in previous years. In terms of the long part of the curve, the further you go out on the curve, the higher those rates are. Yes, you can earn a higher return, but there's also a risk called duration risk. I don't want to get into the technicals of what that is because it can be a confusing concept, but the longer your duration, the more you potentially stand to lose in times of rising rates.
Right. So we hear a lot of people talking about risk, and the stock market feels risky. There's been a little bit of volatility recently. Is the market overvalued? Is it going to collapse again? But the alternative is to be, for many people, is to be, okay, if I'm not in stocks, I'm in bonds. And I think what we want to poke a hole in is that there is still risk there. And the chart I just put up here is just the year-to-date increase in the treasury rate up to that 1.6 range. And this purple line here is the Vanguard long-term bond index, which is down 10% year-to-date. So it is possible to even lose money on your safe side if you're not cautious about where that's coming from. How should investors feel about market risk and things feeling frothy sometimes?
There are going to be periods of time each year that are going to have intra-year declines in the equity markets. That's one thing that we all know. Almost every year has some period of intra-year decline. However, most years actually end with a positive return. So you have to be able to ride out some of that volatility, ride out some of that risk in order to generate that return.
Right.
And I think we also have to strip out, when we say the markets, there's not one market, right? So we have, the S&P, which is what a lot of clients know, that's large cap equities. We also have mid cap equities, small cap equities. We've got growth oriented investments, value oriented investments, and that's just in the US. We have the same thing internationally, same thing in emerging markets. We've got real estate investments. So the market is this overall encompassing thing that really has a lot of component parts to it. It's not just one market. So
we've touched on a couple of things here. We've talked a little bit about sides of the stock market that have been doing well. all of our clients have some balance of stocks and bonds of different varieties and shapes and sizes. When we talk about the momentum trade, the things that have been doing well will continue to do well. That doesn't end when there's a particular event. It happens, on a random Tuesday in March. Right? So, that's part of what we're trying to do, with your help, is to say, how do we make sure that we have exposure to these different places, because we don't know when the cycle turns, right?
If we knew when, we'd all be sitting on an island somewhere counting our money. I wish we knew how, and I wish there were other people that knew how, because we'd all follow them as well. We just don't find that it exists. People are often very early in their calls or late in their calls. And either way, if you try and time the markets, just many people we've seen are just unsuccessful doing it. If you're trying to time the markets, you've got to be right when you get in, and you've got to be right when you get out. And trying to get both of those things correct, even partially correct, if you miss a few days, can dramatically change the trajectory of your return. So our philosophy is, if we're not going to be good at it, and not even remotely good at it, let's not even try to play that game. Let's stay invested, but let's be smartly invested. Let's be diversified. Let's have allocations to all the different parts of the portfolio. And let's focus on, again, the things that we can control, like our asset allocation, and not things that we can't control in terms of what markets are going to do well or not over the next 6 months.
To close, one quick personal note, coming on board with Morton Brown, you joined a team of runners. Katie's done her half or marathon competitions. I've run up a couple ski slopes that were ill-advised. You've completed a half Ironman in your athletic history. Is that true?
Completed one, yes. Barely. I visited the medical tent with 2 liters of IV after going through the finish line. So yes, I physically completed it, but just barely.
Wow. Yeah, that's the biking and the swimming. We haven't added those on yet. That's pretty impressive.
Yeah, it was an interesting event. It was 103 degrees during most of my bike ride, and about that warm during my run. So I don't recommend doing that kind of race in that kind of heat. That was not what I had prepared for. But yeah, I'm glad to have that under my belt, and hope to do another one in the near future.
Sounds good. Listen, we thank all of you for joining us. We really appreciate it. If you have any questions or follow-up for myself or Eric, feel free to reach out to me. But in the meantime, wish you all the best, and thank you for your trust. Eric, thanks for joining us today.
Thanks, Dennis.